Welcome to Building Better Communities with Bob Hart, the podcast that dives into the stories of the leaders in commercial real estate and beyond as they talk about their careers, the market, and what it takes to build better communities. In this special episode, live from Abu Dhabi, Bob sits down with Dr. Sam Chandan, founding director and professor at Chen Institute for Global Real Estate, for a forward-looking discussion on what's next for commercial real estate, inflation, international capital, technology, and policy.
Delighted to be joined by my friend Bob Hart. Bob and I have been working together, I should say that I've had the privilege of being able to lend a hand where I can, for a couple of years now. Bob is the founder and CEO of TruAmerica, which has about $20 billion of assets under management in the United States, focused almost exclusively on the workforce housing sector. This is a critically important one, dovetails to, Kayla and and other conversations that we've had today around housing affordability. It's not capital A affordable. Workforce and essential housing, as we'll hear about, really focuses on that middle piece of the market where you're not taking advantage of or leveraging government subsidies or incentives. It's also not at the other extreme, luxury, the luxury segment of the market. It's the housing where we think about the needs of teachers, firemen, police officers, people who serve the community, and there are two really essential aspects to this. One is that we have to think really creatively and work really hard to make workforce housing work, given that it's often very difficult, if not impossible, to build new workforce housing ground up. The other is that there is a critical and demonstrated and pervasive need for workforce housing in almost every significant metropolitan area in the world. And so, that unaddressed middle of the market is on one hand an incredible opportunity, but on the other hand, one that is, I would say, chronically underserved. We're going to talk about first, the investment climate in the United States, where we see ourselves in the U.S. real estate investment cycle. Then we'll dig in a little bit further on what we see happening in the multifamily sector specifically. Bob, thank you for joining me here.
Good to be here, Sam. And congratulations to you for launching the center here, and to Dean Solomon. And you guys have done an amazing job. So how about we have it out for Sam here a little bit? Huh?
Thank you.
You're going to do it again. You're going to come back next year.
We will grow into this magnificent space that has been built for us. We're very grateful for it and for the partnership with the Abu Dhabi government. Bob, I think the question that may be on a lot of people's minds who are based outside the United States. We've obviously had a challenging, let's say, 6 to 8 weeks in terms of, how it is that people are around the world internalizing the messaging, and the signals from the United States. Notwithstanding, some of the more assertive moves that we've made in the U.S., bottom line, is the U.S. still open for business? Is it the case that American investors, developers, are still actively seeking to partner with capital providers and others from other parts of the world?
I would say unequivocally yes, but there's been a reset in the way American policy is being demonstrated, obviously by a very different administration than what was in office for 4 years. And although there's been what we'll call external measures, whether it be tariffs or tougher trade talks, tougher treaty talks and all that, you have to look internally to the United States, and you look at a country that continues to grow by several million people a year. It's a country with 335 million people. It's a mobile society. Things are evolving and changing, whether it be in the way we transport data through data centers, the way we live throughout the country. There's so many dynamic factors that make the United States a very good place for investment.
And I think my takeaway from some of the, again, shifts in language, and policy approaches to engagement, with the rest of the world is that, part of what the United States, is, seeking to ensure is that capital does flow, into the country. There's no desire to see, with the exception perhaps of, assets that are defined by, national security considerations. There's a strong desire to see, providers of capital, investors from other parts of the world, really deploying their resources, in the U.S. in a way that might, drive growth and investment, what for us is, at home. So, capital flows in terms of, cross-border capital flows, where are we, in the recovery? Was there a significant drop-off in cross-border investment into the United States during and after the pandemic? Do you expect that cross-border, investment to the United States will strengthen in 2025?
Well, I think there was a lot of cross-border investment leading up to and through the COVID period, in part because asset values were climbing, we had lower interest rates, and instead of the COVID period slowing everything down, it created a bit of a stimulus because of all the money that went into the system. And when that spigot shut off and interest rates started to climb again, I think that equity investments particularly started to slow down from both foreign and domestic capital sources, and we've seen much more investment in the credit space and other spaces that have maybe, we'll call it a slightly lower risk posture, because people not wanting to invest at a time when they're not getting the amount of cash flow they would normally be getting when interest rates were lower. So there's been a reset.
Yeah. Now, when you mentioned interest rates, Brian Klingsik earlier this morning talked about how our expectations around what would happen with interest rates, the degree of slope on the yield curve. A lot has changed over the last 5 or 6 months, completely independent of the political environment, and we have a much steeper slope on the yield curve than has been the case really for the post-pandemic period when the yield curves have been inverted and those longer rates have been lower than the short-term rates. How is that impacting your thinking about the U.S. real estate recovery? When I look at sort of ULI's, I'll mention ULI Emerging Trends report again, sort of when those interviews were being done that ultimately feed into the report, that was in the summertime, that was in September, and I think for a lot of decision makers, 2025 was going to be the year where the Fed funds target rate was coming down, capital would become more readily available, the underlying cost of capital, that would become more favorable as well. That's not where we are, at least not for once we move out on the yield curve. How is that shaping your thinking about the recovery?
Well, let's start with the transition. 23 and 24 were slower years in terms of real estate that transacted in the United States because of all the things we know about, the higher interest rates, the slowdown in growth, many, many factors. So everybody was expecting, or at least thinking they were expecting, to see a softening in rates and an emergence in growth again to stimulate transaction activity. At least in the multifamily space, that has not come to bear yet. But a lot of the smart money is putting their bets down because they see the trend coming out. So there's an impetus to get money out there. It's just not at the same level of frequency yet, because why take an equity risk when you can just take a credit risk and maybe cap even though your return may be capped, until they see clearly a pathway toward lower risk on the equity side. You're going to continue to see flows not coming in quite at the same pace they were 5 years before, we'll say.
So, I mean, when we think about sort of whether the flows of capital into the sector are stronger or steady, one of the metrics I like to look at is, and it's a proxy, it's an imperfect proxy for the market, is the market capitalization of the different REITs by property type, and it's instructive for me because what it's shown pretty consistently post-pandemic is that those property types where the value proposition is not about bringing people together, so industrial warehouse spaces, data centers, self-storage, they're outperforming other commercial real estate property types. They're still not keeping up with the S&P, unless you take out NVIDIA. But when we look at sort of office, hotel, retail, they're underperforming, pretty significantly. In the hierarchy of asset classes, are there how have investors' attentions shifted? Over the last couple of years. Obviously, we've got a lot of big institutional players that, with the exception of the very best quality office, have soured on office as an asset class, or at least at this point in the cycle, maybe looking elsewhere. Are there asset classes that as compared to historic norms are simply getting more attention today?
Absolutely. I mean, let's start with the worst is certainly office. There are contrarians, though, that are buying office at cap rates that have double digits. They're able to get financing, and they're making a bet that some sectors of office will come back, but that's just not the norm. So the office sector, for demographic reasons, for other reasons, other than in selected submarkets around the United States, is really going to take a long time to get back to any sense of where it may never get back to that. We're just largely overbuilt in most sectors. I think industrial, small industrial has continued to gain more and more popularity because of its predictability and ability to generate alpha through cash flow and the high demand for storage and other spaces. You've seen data centers gain tremendous popularity, and everybody's always looking for the new next thing. Multifamily and housing, I think, has been pretty consistently valued over time by institutional investors because, as we like to call it, the cash flow is pretty sticky. Despite all the political things going on, people need someplace to live, whether it's at the high end of the spectrum or the workforce sector or even at the regulated sector of the housing spectrum. There's just tremendous demand for housing. The United States continues to be underhoused, starting in the period that followed the GFC, the Great Recession. Housing new production fell off for a period of years, and just has only caught up in the last several years. And now, when you look at the permit activity, it's falling off again. So I think we're going to see continued demand and durability for housing in the United States.
Yeah, so I do want to pivot, to a deeper dive on multifamily. Before we do that, though, I want to put it in the context of what's going on in the larger housing market. We focused a lot over the last couple of years on what's happened with the short-term cost of financing, what's happened with the yield curve. As we move further out along that yield curve, mortgage rates have risen abruptly, perhaps not to the 13-14% levels that few of us will remember prevailed in the 1980s, but certainly to much higher levels than we've observed since before the housing boom. From a policy perspective, it troubles me that on one hand we're not seeing very much single-family home construction, and we have much higher rates than we've experienced in a long time, because that has that implies a serious deterioration in single-family home affordability. And there's a lot of folks who might want to make the transition into home ownership because of where they are in their household's life cycle that simply don't have the opportunity. Again, from a policy perspective, I see that as problematic in part because while it's not the most efficient path to wealth building and intergenerational wealth transfer. It may be the most efficacious path, to doing those things. All of that being said, as policy background, is it overly simplistic to say that demand for workforce and essential housing benefits from constrained affordability in single family?
It definitely benefits, but the group of the cohort that rents in the renter by necessity category is just a very large cohort. And we don't build housing in America for that purpose. It becomes that through natural attrition. The other thing we've had in the United States is we've had delayed homeownership for a long time. About a third of the people in the United States rent in some fashion. And as I said before, the biggest cohort is workforce housing. But you have two problems in the single-family market. You have entry-level buyers that need a mortgage subsidy to qualify for a 7% interest mortgage. So your home builders are doing that in order to get products sold, but they're not building housing en masse because they don't want it to sit on their books, particularly if they're public builders. On the other hand, move-up buyers who financed in the last 5 years may have a 3% mortgage. And they're not keen to give that up to trade up to a 6 or 7% mortgage. So you have this big constraint in the system that's slowing down the liquidity of the trade because you need to move up, move down, and sometimes just living in an apartment may be a simpler thing to do, which allows for more mobility, more choice, and just better savings of people's dollars.
And when we're thinking about the supply side issues here, but back in sort of the essential and workforce space, if it's the case that in most instances we won't be able to build workforce ground up, and so we're dependent upon essentially what may have been Class A 20 years ago, becoming part of the workforce inventory, not only in terms of the aging of the asset, maybe some of its physical characteristics, but its location being right as well. Does that mean that we're perennially undersupplied in terms of the availability of workforce in the U.S.?
You would be if the pace of construction continues to be metered the way it has. Yeah. But you have two things going on. You have a lot of housing being built, as we talked about, at the luxury end, where the rents are unattainable by those in the service industry or, the blue and gray collar cohort. But you don't have enough housing at the lowest end, which is the subsidized affordable space. And so that creates this huge push into the middle of people that can't afford luxury and people that don't qualify or have enough choices for what would be deemed affordable housing. So maybe that cohort is doubling up, living two families in one unit or multiple people that, so you keep pushing that middle, which is what what we do at TruAmerica is we see that as a big spectrum of housing. So we try to identify that housing which can be further improved for better quality of life and for, of course, to be able to enjoy the better income from it.
I want to ask you a little bit about sort of a geographic dimension around workforce in the United States, and it applies to housing more broadly as well. We've obviously seen a significant number of climate events in Florida, in LA, where you're based. How is that impacting? And are you seeing an impact on migration patterns, location decisions? Certainly in some parts of the country, it's had an impact on insurance premiums. How is it impacting, how's climate impacting or influencing the dynamics that we see in the multifamily sector?
The three big climate impact areas in the United States are Florida, Texas, which are two of the most growing states in the United States that have the most in-migration, and then California, particularly Southern California, which has had more out-migration. but it's a very, very large metropolitan area. I don't think the climate side affects the consumer behavior of rentership because they're not necessarily insuring the owner is, even though that cost may be passed through the overall cost of the property, and job demands are what they are. But on the investment side, you have not only just headline risk, but you have operational risk of storm damage. We've seen that in Florida with insurance rates rising over the last 5 years from, we measure it per unit. It used to be about $500 or $600 per unit per year. Now it's $2,000 for some folks, unless you have a very large scalable portfolio like we do. Similar dynamics in Texas. And although we've enjoyed for a while less calamities in California, we just saw this major calamity, which is going to affect insurance rates. It's going to hit the single-family market much harder than the commercial market, but nonetheless, insurance is nothing but a large co-op. Everybody shares in losses. So it definitely affects the psychology.
The overall, if we take sort of a step back from the specifics around sort of these areas, and I think your point's well taken that, Florida and Texas, are high growth states, and whereas California, the third story here in terms of sort of the observable climate events, the discrete observable climate events, is one where, due to a range of other factors, that are at play, tax efficiency issues and others, there's a different sort of population migration dynamic at work. But it's, LA, is fundamentally a huge market, the second largest in the United States. Take a step back from all of that. How are you thinking about the next year, couple of, probably more along the lines of, the next couple of years, the investment proposition with regard to workforce? Where are we in terms of, value recoveries, fundamentals? Do you see the next couple of years as sort of, an opportune time to be deploying capital in the sector?
I think it could be this next vintage, we'll call it, for the next, call it 5 to 10 years, could be some of the best opportunities in the United States. We've seen a steep absorption curve in certain American cities that's taking place where we had some oversupply. We've had a lot of interest over the last 10 years in Sunbelt investment. And so things have naturally slowed down from a growth standpoint, but the table is being set for a surge because more and more investment will start to flow again. And if you want to put your bets down, the time to do it is not when everyone else is doing it, it's to do it beforehand. So I think that it's a very good timing opportunity if you're willing to start. Maybe you'll be a little early, but you'll be on the curve.
So one more question for you about this. I think there has been some more reserved reporting and analysis around the multifamily sector in the last 18 or 24 months, in part reflecting that. Or I'd say largely reflecting that we've seen significant new additions to the inventory. A lot of new supply has come online. How well are we doing in terms of the absorption of that supply? With construction activity in the pipeline now dropping off, do you see this sort of as a cyclical phenomenon where the market returns to sort of strong rent, strong and sustained rent growth, over the near term, or are there markets where it'll take a little bit longer than that to absorb the new inventory?
Well, there are definitely markets that have been grossly oversupplied. The number one growth market had been Austin, Texas. Now it's the worst growth market because there was just too much developer speculative housing. However, that housing is being absorbed, but that market, maybe parts of Dallas, are going to take a little longer to recover due to the high amount of construction there. But we have so many undersupplied regions. The Northeast is very undersupplied. Boston is a constant growth city, a lot of in-migration on high-paying jobs there. New York is well occupied, over 95%, and so forth and so on. And even on the West Coast, where we've had episodic climate issues, you still have high in-migration for workforce-type housing. You may have had some out-migration, but you also have in-migration as well. And, those areas are also, continuing to grow. So it's selective. It's one size doesn't fit all. And I think everybody has to look at the regions of the country and decide where they want to put their bets down.
Yeah. So we have time for probably one question if folks want to jump in with regard to the U.S. outlook, the multifamily sector, go ahead, Mithun.
Thank you.
Right.
We're good.
Thanks. From an investor point of view, if we are looking at a lot of opportunities coming up from the way you just mentioned in your last conversation, what kind of returns can be expected?
Well, on a levered basis, I assume you're talking about with leverage. I think that, you have to rationalize returns because cash flow is still a little bit more muted because multifamily cap rates have not gone up so high. They're still in that 5 to 6 range, and interest rates are in a similar range for qualified borrowers. So, but I think on an overall return basis, a 15 over a 5-year period is reasonable for a return.
Maybe we'll fit in one more quick question. Let's see. On the investment outlook in the United States. I have.
I think I scared them all.
Yeah, no, we might have. Or they're just afraid to ask anything, too pointed to an American on stage. I'll offer the closing question then. Given sort of your TruAmerica's role in acquiring sort of let's say for lack of a better term, let's just say B properties, but then making really meaningful, targeted improvements to enhance the quality of life, for residents in a way that also sort of it's a win-win. It enhances retention and longevity in the properties as well. Referring back to sort of a question I'd asked earlier, in the context of development elsewhere in the world. How sensitive are those kinds of improvements to changes in material and labor costs? If there's an abrupt shift to the availability of skilled construction labor, if softwood lumber prices rise, or perhaps even steel and aluminum are not as widely used, in low-rise, in garden multifamily, how sensitive is this type of improvement to uncertainty or volatility in those kinds of costs?
Well, from a good standpoint of raw material, it's not significant, even though you may have slightly higher lumber costs or oil products cost. It's not. But where the real problem comes in is if you have labor shortages, because a lot of the labor is entry-level labor in the United States, and that labor has already cost, in some areas, double what it was 5 years before.
Yep.
If you limit the supply of that over the border, you will have issues in rising labor costs, which, there's only so much the Class B renter can pay.
Right.
So it may limit how much you can improve.
Yeah, but that's that's also part of your ethos, right? Even if you were able to, and I guess the closing question then, how do you think about balancing that? Because I know that sort of part of your goal at TruAmerica, and forgive me if I'm and correct me if I'm mischaracterizing this, you want to keep properties that are affordable, to that median family. You want to keep them, within reach. The goal is not to price them out of the asset.
That's exactly right. The goal is to find opportunities that can be priced and improve, but still maintain affordability. That's the key. So we don't over-improve to just try to squeeze more rent from the consumer, because they won't last. To create that durability, you have to price it that people will want to stay there, as opposed to, these apartments rent for under $2,000 a month. So $100 to $200 to someone who has a household income of $60,000 could be a lot of money.
That makes a big difference.
Makes a big difference. So the big concern is labor.
No, that absolutely makes sense, and certainly a potential source of uncertainty for us. We think about the outlook, for the United States and what domestic labor policy and immigration policy might look like, over, I was going to say the next couple of years, but perhaps even the next couple of days or couple of weeks, as things unfold on an accelerated
We
time
have
frame.
to have control over the border, but at the same time, we have to have orderly immigration.
All right, Bob, thank you so much for making
Thanks,
the trip
Sam.
to Abu Dhabi.
All right.
All right.